Before I review exercise 3-5 in your textbook, I just want to give you an overview of the balance sheet. And the first thing I want to talk about is another name for a balance sheet is called a financial position. And the reason or the easiest way to remember this is the balance sheet is a picture at a specific date. So remember, when you label the balance sheet, it is at a specific date. It's a picture at that time and date. So in most cases, we use a calendar year end of December 31st, 2021. So that is the financial position. That's their assets, their liabilities, and equity as of December 31st, 2021. The usefulness of an asset of a balance sheet allows us to calculate using financial ratios, which you will study in detail in financial management. You'd be able to determine how liquid the balance sheet is, their ability to pay their bills on time, their long-term solvency. You would be able to project if they were able to pay their bills not only as of the end of December 2021, but how much that they do have, and when long-term liabilities become due, will they still be solvent to pay the debt as payment is due? And another thing to remember when you look at the balance sheet, is it financially flexible? For example, say a company has the opportunity to purchase an asset that will give them a 10% rate of return, but are they able to borrow the money if they don't have the cash at a rate lower than 10%? So a company that would have financial flexibility has the means to actually borrow money at a lower rate than the expected return would be. Now, you know from financial accounting, the limitations is the historical cost. We also discussed this in chapter 1. Historical cost means we record our assets at its original cost. And one thing they bring out now is not all assets are on the books. And what they're really referring to is a big asset of a company is the resources they have available. And a lot of the resources are on the balance sheet, but however, their employees are not on the balance sheet. And employees are an asset unrecorded because they have the talent and expertise to to be part of the mission of the corporation and be a key part in the production or sale of the asset they are making or the asset they purchase for resale. The other thing I'd like to talk to you about is the classifications. You've studied a classification in financial accounting, which you'd have current assets, long-term assets, current liabilities, long-term liabilities, paid-in capital, which includes common stock and paid-in capital in excess of par, and your retained earnings. Now, how do you determine if an asset is current or non-current? In most cases, it will be current if let me back up, and I should probably explain to you what an operating cycle is. An operating cycle is a company has cash. They invest the cash in inventory. When they sell the inventory, they create an accounts receivable and a credit to sales, and then they collect the cash. If the accounts receivable is collected many times in a year, in 1 year, that operating cycle would be 1 year, and so all assets would be current each year. So at December 31st, that would represent current assets for a year. However, if it takes them 2 years or even 18 months, any time frame greater than a year, if it takes them a while, by the time they would take the cash, create the inventory or purchase the inventory and sell it, if it took them more than a year to convert it to cash again, then the operating cycle would be more than a year. Here's an example. I noticed this in the cheese section at the grocery store. You have cheese that takes 18 months to age. In that case, if that is the main product the company sells, then the operating cycle would be at least 18 months because it takes 18 months to age it. Then after aging the cheese, you would sell the cheese to your customers, and therefore the operating cycle would be greater than 18 months, because if you can sell it started after the 18-month period is complete, how long does it get to convert that aged cheese to cash? So that's an example of how an operating cycle could be longer than a year. In most cases, especially in this textbook, you will be dealing with an operating cycle of a year or less. Now, look at exercise 3-5, the balance sheet preparation, and they give us the following ending balance of accounts in December 2021 for Valley Pump Corporation. And they give it to us in different orders. And at the end, they give us additional information. The $120,000 balance in the land account consists of $100,000 for the cost of land where the plant and office building are located. The remaining $20,000 represents the cost of land being held for speculation. The $44,000 balance in the investment in equities represent investment in common stock of another corporation. Valley intends to sell 1/2 the stock within a year. And the notes payable account consists of $100,000 note due in 6 months and a $150,000 note due in 3 annual installments of $50,000 each, with the first payment being due August 2022. And they ask us to prepare a classified balance sheet. So the cash would be the first we would look at, and the cash is $25,000. The accounts receivable is usually not shown right after cash if there is an investment in equity securities that are short term. So in this case, the $22,000 really represents investments, and if you go and look for the investment in equity securities, it's $44,000. But in the additional information, they did tell us that half was going to be sold within a year. So we took the 44 times 50%, half of it, 22,000 would be a current asset, and then in the investment in equity securities and categorized as current asset, and the investment in equity securities for the remaining 22,000 would be investment, a long-term asset. Interest payable we'll go over with the balance sheet. On the liability side, land, they told us, is $120,000, and in the additional information they gave us, they told us that $20,000 of the $120,000 was land held for speculation. That is an investment. When land is held for speculation, not to be used for business purposes, but used for investment purposes, then that land should be reported as an investment of $20,000. Now, if we keep going down, we will see land, the $120,000 given to us in the problem, plus the additional $20,000 information included in the end of the problem, at the bottom of the problem. $100,000 was used for the building of the company, which is used in operations, and they gave us that amount to be $300,000. And the equipment, there was no adjustments to the equipment, so that was $75,000. So our total property, plant, and equipment would be $475,000. There is $100,000 of accumulated depreciation on the building given to us, and $25,000 accumulated depreciation given to us of $25,000. And our total net property, plant, and equipment is $350,000. And if we go down, we see a copyright, and the net copyright, which is an intangible asset, is $12,000. For total assets, we have $615,000. Now, I didn't go over as part of the detail, but inventory remains at $81,000 as presented in the information, and the net accounts receivable is $56,000 less the allowance for doubtful accounts of $5,000. So the net accounts receivable, or the net realizable value of accounts receivable, is $51,000. And the prepaid expenses are given to us in the problem, and they tell us it's 12 months, so the full amount of prepaid expenses is $32,000. Now let's go and look at the liability side. And the liability side, they would start out with the current liabilities, and that's known as accounts payable, and that's $65,000. Another current liability is interest payable of $10,000, which is given to us in the problem. Deferred revenue, we know that to be a current liability if you earn it within a year, and that is given to us in the problem as $20,000. Now, as far as the notes payable is concerned, they tell us it's $250,000, but in the additional information given to us in the problem, they said the notes payable is $100,000 that is due within a year, and there was a $50,000 current maturity of a long-term debt due within a year. So, and they specifically said down in the notes payable, set additional information requirement 3, the notes payable account consists of $100,000 note due in 6 months and a $150,000 note due in 3 annual installments, with the first installment due of $50,000 in August 2022. So that current maturity of long-term debt is due August of 2022. It's due within a year. That is why it is listed as a current maturity of long-term debt. The remaining debt is considered a notes payable greater than a year from the reporting date, December 31st, is $100,000. And then they gave us the common stock to be $200,000, the retained earnings to be $70,000. So total shareholders' equity is $270,000. And we compare our assets of $615,000 to the total liabilities and equity of $615,000. So it's balanced.